What is going on, you guys? Happy Sunday. Got another week here. I'm going to continue to keep doing these things for the foreseeable future. I think I think what I really like doing is, although even though I sometimes start to notice that I kind of get repetitive with a lot of the things that I say, but it really has a lot to do with like the frequency that I do a lot of these live streams. Like things really don't change that much over the course of a week. I do think that eventually, sometimes with like a lot of content creators, they have a lot of difficulty like actually being able to create new and impactful and more importantly like valuable material. A lot of content creators don't really deliver that much value because they have to deliver so much. What's going on, Sam? And I think that this once a week thing is actually perfect because, like I mentioned, things don't change every single day, but they change pretty like monthly. But this once a week sort of thing, I mean, this is a good cadence I think that we got going on here. So I'm going to keep trying to do this once every single Sunday right before the markets end up opening. But yes, Sam, there is lots of gurus on Twitter with garbage. But what I want to do here today though is actually talk a lot about market cycles. And I'm not sure if you guys have ever read the book Mastering the Market Cycle by Howard Marks. Um, really important book because when I first read that, the first thing I thought to myself is that like he wrote that back in like 2007 2008, and it was exactly like what we experience every single day around here. Yeah, exactly. It has been getting a lot really out of hand the last few weeks because everybody is right. So like Sam, as you ended up mentioning in the comments right now, it's like, and this is why I wanted to talk about the market cycle, is that things are getting really exciting out there right now, and there's a lot of people, and I mean, sure, if we're making money, that's cool, whatever, not a big deal. But at the same time, it's like, how do you know how to master the market cycle? What are the things that you actually have to watch out for? And like, what's the discipline? Like, what's the mind discipline that you need to have in order to make sure you don't end up losing money again? Right. And that's exactly what I want to talk about here. And when I say again, I mean like in 2021, that was the last peak that we ended up having. And a lot of investors got blown out. And more importantly, like not only did they get blown out, but they didn't take advantage of the 2022 market cycle bottom. That actually led to a lot of the portfolio results that we have had. So now we're hitting new all-time highs. A lot of us that ended up did accumulating stocks to that 2022 bear market. Now we're all hitting all-time highs. We have just magnificent returns. But a lot of people actually ended up selling stocks back in those days, and then now we're resetting, and now we're actually transitioning to a lot more of a frothy period that is, I think, leading to what could potentially be damaging results in the future. So, like, how do we make sure that we're actually generating real results over time? So, I think I got a couple things here for you, and what I wanted to do is actually let's do presenting. All right. This is a tweet that I ended up sharing not too long ago. Um, it actually got a lot of results, so it's kind of cool. 69 likes. That's awesome. But anyway, when you walk your own path, I think that this is something that I wanted to talk about here. Is like when you actually walk your own path. And I'm going to make this a little bit bigger of a screen. There we go. When you walk your own path, it is a really challenging thing to be able to do. Like when you actually see the crowd going one way, so you see the rest of the crowd going to the right, and you actually want to just go to your left. This is often what it's like in the financial markets, but when you start doing the right thing, right? So like everybody wants to swim with the fish. Everybody, it's almost like innate for us because if you think about it from like going all the way back to like school, right? Um, from a very young age, we're taught to not be too different. We're taught to go with the fish. We're taught, like this is how you need to act. This is how you need to behave. This is how you actually yield results. Like these are the grades that you need to get. These are the books that you need to write, and swim with the fish and don't get too far out. And this even is like applicable even in corporate America today. A lot of the jobs that we have, like this is the way you go. And if you stand out too much, sometimes that could be negative. And then if you don't stand out enough, that can also be negative too. But the one thing and the one category of life that actually yields the best results by going against the crowd is actually going to be in investing. And this is why this image is so impactful, is that because when you think contrarian to what other people are doing, what the vast majority of people are doing, and actually sometimes I have like the sentiment indicator where people start attacking me on my timeline by saying something. That's how I know that it's the right thing to say. Like when you actually start going against the grain, when you start going against like the current of like the flow of the markets, people are not going to like that. And sometimes that's not super popular. And honestly, honestly, as a content creator, that's not what really sells. Like what actually sells as a content creator is by going with the market cycle, getting bearish when everybody is bearish and getting euphoric when everyone is getting euphoric, or buying Nvidia like right now and being a long-term Nvidia investor when I know that I clearly missed the run, or SMCI. Like I could definitely be doing something like that, and that would yield better following for me, and even like better sales for me. And I know this, and a lot of investors know this, and a lot of like FinTwit influencers and YouTubers also know this. But that's not what's going to be the right thing to do, and that's exactly why I try to go up here and like talk about everything that I do, because I got my own job. I don't need any more money. I don't need anything. But what I do want to do is I want to help people, and that's exactly why I constantly talk about these things, like keeping a level-headed approach. All right, so this is essentially what we ended up experiencing recently. This image in particular is what I wanted to pull up. Like what I think that we're right in between excitement and thrill. Right here, so like we're getting to the close of the top of the market cycle. Um, I mean, right now we're gonna actually go over some technicals, and there's a lot of technical indicators right now that are actually kind of concerning me right now. But essentially, the thing to think about is like, actually, I think I'll go right to it. So you can see that even on the weekly RSI right now, it's overbought. Um, excuse me, I was hiccuping. And you can even see like right here, and I actually put like these black marks where the previous times when the RSI got this overbought. So you see basically a brief bear market right there, or like a correction. It happened right here in 2007. It happened right here before this little correction right here, and then obviously I think that there was just basically overbought conditions for a long time, from 1995 to 2000. So it's not a perfect indicator, but what it does is it shows you exactly. And I actually pulled this up on the Nasdaq. What I think what's more important is like these time periods when things are really overbought doesn't it basically tells me that this isn't probably a great time period to buy, that I should have been buying previously. And I put this right here where it says point of maximum financial opportunity, right? So from a visual perspective, like on the charts, we can actually see like on the weekly RSI with the Nasdaq that these time periods right here when the RSI is getting extremely oversold on the Nasdaq, these are the best time periods to buy. So you got like COVID crash, you got the 2018 bear market, you got the 2022 bear market. You even have like the 2008 time frame here, and like basically this is the 2011 bear market. And you got the 2014, 2015 bear market. So like these time periods when you actually start to get really oversold, these are the time periods where people, and let's actually go back to this anatomy of the market cycle. This is the point where people are actually doing the panic, capitulation, and despondency, where we do have that point of maximum financial opportunity. So the way that I think about it in my portfolio is that what I like to do is I don't always show the exact amount of cash that I have, like investable cash that I have in my portfolio, but like right now, so like we can actually go to it. I pulled it up here for you guys. So right now I have about so I got a very small cash position, like a 1.4% cash position. Um, but this isn't the all the cash that I have. I usually go a lot more heavier when we do have some sort of correction, or when we do have that despondency or the panic and the fear and the capitulation. Not because I'm trying to be a contrarian and like outsmart people. It's a lot more along the lines of like, um, this is the point where stocks are actually getting pretty cheap, and we do have that maximum financial opportunity later on down the road. I mean, like what I have been looking at here too is I've actually been looking at a lot of the valuations on stocks. So like right now, I mean, not only are we overbought on a technical basis, but valuations are extremely high, and we are actually transitioning to. I think that the best way to really describe this market is like a greedy market, right? And I'm going to make a point here in just a second, like why all of this is so important, right? But right now, valuations are extremely extended. The last time that was actually a quality buying opportunity was in 2022, which was the year of accumulation, and then also the last correction that we had in October. Those are the last couple times to really start thinking about buying stocks hand over foot. So like, let's go. Let me tell you exactly like what I'm seeing here. Um, so I'm going to go back to this. Okay. So the reason why this is so important is that I'm seeing a lot of investors right now on X and on YouTube and on basically everywhere, and they're tripping over themselves right now, and they can't stop buying. Like they want to buy as many stocks as possible. I think so. MC, I think that we're going to have a secular top soon. I don't know if this is going to be it. I think that this is probably a lot more of a cyclical top is what I'm talking about, because like a lot of this could actually be solved by like a, like a 15% correction, 15 to 20% correction, which is going to set up for a great buying opportunity, honestly. So, like right now, everyone's trying to buy these stocks that are, have like 99 RSIs. I mean, things are just running and they're chasing. And this is exactly what I ended up seeing in 2021 during that last market cycle peak. And a lot of other people, they always want to pound their chest and they're like, oh, look at these gains, like, and I can actually see it on my Twitter timeline where everyone starts pumping, like sharing their portfolio returns. They start, and it's like, it's the weirdest thing. Just you can fade it every single time. And so like every single time that people start like pounding their chest, sharing their portfolio returns, talking about how they're a genius, start pumping their newsletter subscriptions, whatever they end up doing, and just saying like, I picked this best stock and now you should follow me. And it's like, well, that's kind of what everybody does, everyone's going to get lucky. A broken clock is right twice a day, but it's not necessarily, and I shouldn't be calling all these guys out, but it's the truth, right? This is exactly the time period where I start to get the most nervous, right? I start to get the most nervous because this is the time period where everyone is trying to buy stocks that have already ran up. Now, for me, from a portfolio perspective, I'm thinking to myself like, hey, when should I be preparing? How should I be preparing myself with my portfolio, and how should I be positioning myself? So like, I think that something that's also really important to say is like this can go on for a long time. And the last time that I really saw like this arc bubble was a pretty epic one. But this ended up lasting. So like we could potentially be like somewhere in this August 2020 timeframe where it was basically about a year and a half where this actually ended up happening. So it's like thinking to yourself, and for me, I'm thinking to myself, like, how can I be disciplined in this approach? Because it doesn't really matter. And I can actually show you a couple other um, stocks during this time frame where it's like it doesn't really matter when people think that they've missed out on an opportunity. So you got like Teladoc during this time. I mean, this everyone thought this was a great company, and like Mercado Libre is another company here too. Obviously it's almost at all time highs, but during this, so we can actually see that August 2020, it actually still ended up coming back into its major moving averages. I mean, Mercado Libre, I think Roku was another one that was big during that time. So you got Roku, that actually ended up flying, and people just couldn't stop. I mean, like the list goes on and on. Sea Limited here, people couldn't stop buying this company, and it was the next $1 trillion company in the eyes of a lot of people. And then even a crowd favorite, CrowdStrike, who's reporting earnings this week, like this company ended up actually coming back, even though it did make a new all-time high. It did end up coming back into its major moving averages, and more importantly, um, it actually did retrace a lot of that rally. So we go August 2020 and it still came back. Right. So, but there was a lot of people who were posting results on X and on Twitter about how awesome they were, like about how smart they were that they actually own this stock because because it would go up after earnings like 20 or 30%. But then, it actually still ended up coming back. The point that I'm trying to make is that every single time that people think that they've missed a company or they've missed a stock, uh, they haven't, So eventually, at some point, like it does matter what you pay for the company. It's not when you sell it that you make money. It's when you buy it is when you make money. Meaning that if you buy a quality asset for a good price, this is basically what I'm saying, right? I mean, at its nuts and bolts, like what am I trying to say? That these are individual companies, and that there's a price to be paid for these individual companies, and that there's various times throughout the market cycle where it's going to be really expensive, people are euphoric, and then times that it's very cheap and people are despondent and panicky and capitulatory. And during these time periods where people are panicky and capitulatory, this is often the best moments to buy these companies because the underlying asset is still the same quality of an asset, but you're paying less for it. So it's like you get it for a discount, like it's on sale. So it's always going back to exactly what I ended up mentioning with this is like going your own route. So when everyone else is getting really excited about some of these companies that are skyrocketing through the moon, making sure that you stick to a process and looking at the valuation, the price that you're buying of the underlying company or the underlying asset is what's going to yield those long-term portfolio results. All right, let's talk a little bit about the week ahead. I'm going to check some of these. I don't think so either. dang, sorry, Sam. This is whenever I do these live, like sometimes I'm gonna have some hiccups here and there. All right, but I can't remember exactly what I was saying. I think I was looking at this one, where I was talking about a lot of these valuations. So this is the screen that I was originally starting to talk on, where you can actually see valuations are extremely stretched right now, where it's like an average 19.6. Um, Basically, same point. Buy when it's cheap. That's basically what I'm saying. All right, thoughts on small caps? Yes, this is a huge thing. I'm happy that you ended up asking this, MC. So a lot of people are talking about like small caps and what this is essentially what's going to fuel the next bull market. I mean, yes, and no. So let's go back to this screen here, um, where you can actually see that you got a lot of these mega cap tech stocks. And there was another chart that I wanted to show you guys here, where it was this one. Yes, where you got like the S&P 500 forward PE, and then you have more importantly, like what it looked like during the dot-com era. So basically, like for small caps, I mean, right now they are cheap, right? And I do see a scenario where actually during this time, going back to 2000, it was pretty historic because small caps outperformed large caps for many, many years in the future. But this doesn't take away from a lot of the pressure that's going to be experienced in the overall markets. So like I constantly thought about this, where it's like, okay, so if Microsoft comes down in price and it actually comes down to a more reasonable PE, like a 20 to 25, like what's going to happen to my software stocks? They're going to go down, and a lot of companies are going to go down because of the way that the institutions behave. Like institutional money is essentially what's propping up these stock prices right now, where it's like they're all piling into the same few companies, and it's the institutions that create these stock market bubbles. By the way, guys, like they're the ones that are piling into the same companies because they need to yield some sort of results to look good for their investors and their clients, right? So they're the ones that are always like, oh man, I can't stop buying all these companies. It's like retail needs to be understanding and being aware that they do chase, that institutions definitely chase, and they do the same thing too, where they like rush out the door. So when you actually look at a lot of the small caps right now, like especially on the forward PE perspective, it's like we don't have too much more of a rally to go before we actually get to that 2018 2019 mark. I mean, what is that, like another 20% upward move in the S&P 600 and S&P 400? So like right now, when I think about like I mean, eventually there's going to be a point where these large caps and the small and mid caps start to converge. They actually come back together. But I don't necessarily think that the narrative of saying like that small caps are going to lead this next bull market forward, when the reality is, like, when you listen to a lot of these earnings calls, the economy is still not that great. So when the economy actually goes through a true genuine expansion phase, like I mean, yeah, the GDP is growing right now, but from a broad perspective, it's really artificial intelligence and like a lot of these AI stocks, like Nvidia and software stocks, like B2B. This is where all the cash is right now. It's like a lot of companies are still cash rich, and this is essentially what's fueling like this next bull market. But if you actually look at the consumer, so like Tesla, for example, or like Indie Semiconductor, which is one of the companies that I own, these companies that are exposed to the consumer are still having a hard time, and a lot of them have been guiding down their future, like next 12 months expectations. It's like Tesla ended up selling off because they didn't produce that great of results, and they didn't know exactly where their deliveries were going to be this year because they go directly to the consumer, and interest rates are still high. When interest rates actually still end up coming down, this is when I can see that the small caps and small and mid cap stocks are going to get a nice bid. But right now, when we think about like how the whole market works, when these large caps come down, it's very, very likely that the small and mid caps are also going to come down too. I hope that answers that question. Um, no, is it really not? Oh my gosh, it's not, is it? Thanks, Sam, for calling that out. This is what I was talking on here, man. I got it. One of these days, I'll get these live streams down. This is kind of like what happens when you do it by yourself. But this is essentially what I was talking about, where we can see like the S&P 400 and the S&P 600, like where the valuation is. And you can actually see like where a lot of these mega cap tech stocks at the moment, like they're extremely overvalued. I mean, like this is absolutely insane to see that. I mean, this is like dot com era kind of valuations where it's like an average forward PE of 28. I mean, I know that they're compounding really great, but it wasn't that long ago that they were still, at a reasonable, maybe an elevated valuation still, but not in like this euphoric bubble space. Where small and mid cap stocks, they kind of have been left behind, but this does have a lot to do with interest rates. So for me, in my perspective, I'm not exactly sure um, if the small and mid cap narrative really makes a lot of sense, especially when you think about like, can it actually fuel this next rally forward? What's going to fuel this next rally forward is when interest rates actually come down. That's what's really going to fuel this next leg forward. But the price of large caps are just too high to where I can't even justify buying it right now. Okay, so let's talk a little bit about. I think that there's no other questions going on right now between YouTube and X. Let's. I want to talk a little bit about like what's going on in the week ahead, and basically what I'm watching. I know that there's going to be a lot of things that are going on out there, but for this week, I know that I'm going to be watching. It's Jobs Week. What our expectations are is about a 3.7% unemployment rate, and this is interesting to me when I actually saw this. Is that the hourly wages? So like if you guys remember January's report, that came out really hot where the wages were actually 0.6%, but now they're expected to only go up 0.2%. So that was really interesting for me to see. So we'll have to make sure that we're paying attention to like what the overall wage growth is. There are a lot of adjustments that happen in January. So I do think that like we need to be, like this jobs report and this CPI for February is going to be more impactful for like future rate hike expectations. And what we can actually do is we can take a look at CME Fed Watch. So we'll take a look at this here. And I'm not exactly sure like where the rate cut expectations are right now. So right now it looks like we're not actually going to cut any rates at the next meeting here in March. And then May is looking like 25%, but we're probably not going to cut rates. But then it looks like June. Yep. June is basically when we're thinking about getting these rate cuts. And also, I do know that in this next upcoming March meeting, it's just in a couple of days, actually, like in a couple of weeks, they're going to release the SEP, the Summary of Economic Projections, where they're actually going to give rate cut guidance based on their consensus thinking. So we'll have to make sure that we're watching exactly how these data points end up coming out between CPI and the jobs data to really get an understanding of like what are they thinking as the Fed? Because the SEP, they've actually been pretty spot on. The only time I've really seen a miss was after 2021, like at the very late stages of 2021, where they thought they were only going to raise rates like 2 times, 3 times, but otherwise they've been really spot on. So we'll have to make sure that we're actually watching what the SEP is thinking, or like what it actually says to us here in the next couple weeks to really get an understanding of like what's going to happen to those small and mid cap stocks. If they do cut, or if they do start cutting and everything does come down, that I think that's going to be a major tailwind for like Tesla, which I think is a really great company to buy right now because eventually these rate cuts are going to happen. All right, so then let's take a look at some of the earnings that we got coming on for this week ahead. I'm watching 3 of them this week: GitLab, CrowdStrike, and then I got MongoDB. So GitLab, if you guys don't know that company too much, basically what they do is they call themselves a DevSecOps platform. Basically what they do is they enable code, like basically developers to write code, and then they integrate, like this platform allows them to integrate within security and the operations portions of the businesses. So it's like a workflow management tool, but for developers. GitLab, it has some major secular tailwinds. It does compete with Microsoft's GitHub, but it has some major secular tailwinds at work here. And I've owned this one in the past before, but I can't quite seem to like fully develop the conviction that I need to have. But I'm going to be tuning in, and I'm going to be covering this company here on my Savvy Trader. CrowdStrike, this is going to be a big one for a lot of people. So this is important, and this is important because Palo Alto released their earnings last like 2 weeks ago. And they said that there was spending fatigue in the cybersecurity market. And then we saw Zscaler's earnings last week. This is gonna provide a lot more context at like what's actually going on in the cybersecurity market. I think the Zscaler unjustifiably sold off last week. That was ridiculous. I mean, it was like a beat all across the board. I do know it was a little expensive. I actually posted about that on Savvy Trader, where it's like they sold off about 10%. And I know that it was the billings guide and something like maybe it didn't come in as strong as expected. But I mean, like if you own Zscaler and if you follow this company, I've owned it for like almost 2 years now, I think. Where I've never seen a quarter. I think there's like 1 or 2 quarters where they haven't sold off on billings, and then they rallied like 20 or 30% on billings, and it was like, oh my gosh, Wall Street, chill. Like you guys got to figure out exactly what's going on with this billings thing. Like you guys got to understand its process. And then MongoDB here on actually a lot of people like Samsara. I'll talk briefly about that one too. But MongoDB, I think that this is going to be interesting for me to see because they are a lot like Snowflake, but they handle a lot more on the database side of thing, and they run a consumption business model like Snowflake. It's going to be really impactful to see how they guide, you know, not necessarily just from a MongoDB perspective, but from a Snowflake perspective. Like, is this trend that ended up happening with Snowflake? Is this going on? Like, because they guided down from 30% next 12 months growth to 22% next 12 months growth. Like that's a huge guide down. Like, is this an industry wide thing or is this a Snowflake thing? And it could very well be a Snowflake thing. They could be losing out to Databricks, or they could just be totally sandbagging guidance. I think that they're sandbagging guidance for the new CEO, and I also think that they haven't innovated their product as fast as they should have, which is why they ended up bringing in a new CEO rather than Frank Slootman. Let me actually talk just a little bit more about that. So Snowflake, they actually ended up selling off 20% last week. But we have to like think about like what's going on with Snowflake's business. So Frank Slootman, if you know the company and if you know Frank Slootman, you know Frank Slootman's brought a couple companies public, and he's supposed to be like between him and Mike Scarpelli, they're supposed to be like this rock star executive team. And basically, they come in and they turn these companies around with a really good product. And Slootman even wrote a book about like operational excellence and sales, more importantly. So Slootman is really, really great CEO when it comes down to taking a good product and basically accelerating the growth in the underlying business by delivering a sales-oriented, a sales-driven culture. But here's the thing about Slootman is that he's not a developer and he's not an engineer. And he's not really that great at like leading the next product innovations, which is why I thought it was actually a really good move by Snowflake and the Snowflake's board, who Slootman is still the executive chairman of, to bring on a product-oriented CEO who understands the AI landscape and understands like exactly what to bring like the next leg forward for growth for Snowflake. So like that was something that I thought was really interesting, and I needed to make sure that I was bringing that up, because back to MongoDB, because that's what we were talking about. MongoDB, it's like, you know, they got a lot of, it's going to be really interesting. You know, I'm bullish. I think that they're going to release really great results. I think that Snowflake actually released good results too, but it's going to be better. It's going to be really good to see exactly like what's going on in the broader market. So Samsara, a lot of people are interested in this company, and I feel like I've kind of missed this one. So the CEO is actually the CEO who ended up developing Meraki, which is like Meraki was bought out a couple years ago, and I used to install these devices. So basically, what it is, it's like they used to do like Wi-Fi, basically like indoor Wi-Fi and access points. And I'm not going to go too far into that because that's irrelevant. But Samsara, what they do is they basically do like an Internet of Things kind of company. So they have a lot of devices that they attach to a lot of like logistics, supply chain, vehicles, or whatever it might end up being. And it runs basically predictive and prescriptive analytics in your supply chain to be able to see exactly like what's going on, right? Like where could there potentially be workflow hiccups? So you can actually optimize and make sure that your operations are doing, you know, better than expected. I'm trying not to use too many buzzwords here, which is why I'm kind of fumbling up on my words. So that's exactly what Samsara does. And then they host so they have like 50-50, right? 50% of their revenue is going to be hardware, 50% of their revenue is going to be software. So they are dependent a little bit on making sure that they actually continue to sell their hardware, which is why I mistakenly didn't end up buying this company, because I wanted a lot more of like a pure software play. But now, obviously, I own a couple other companies that do that anyway. But I was thinking to myself, like with Samsara, I was like, okay, so what ends up happening when the hardware, you know, runs out, like with their companies, with their existing customers, like when do they do they go through like product refreshment cycles? I didn't really know that. So that's something to think about from Samsara's perspective, is that it's not a pure software play. Um, but they are yielding really great results, and they're growing, probably one of the more faster companies out there. So I'll make sure to tune into that one here in this next week ahead. Okay, so let me actually just kind of close things up here. I think we got like 30, we're already 30 minutes, and usually I try to keep these in between 30 to 45 minutes, depending on how many questions we got. I think that the majority of what I'm trying to say here this week is that I think that things are really risky right now, especially on the markets, uh, because there is it's a greedy market, right? And when you have a greedy market, it's okay, right? I mean, sometimes you're going to have situations where the markets are going to be overbought, and there's going to be a lot of greed. And these are the times where you usually just want to like make sure that you just kind of slow down on your buys. Like slow down, make sure to be more selective. Make sure to be a lot more methodical about your approach. Make sure you're a lot more like like making sure you're paying attention to the valuations that you're paying for these individual companies. But because eventually one day a lot of this rally will be retraced. And when it is retraced, these are the moments where we're going to be able to have those quality companies like Cloudflare, Zscaler, or a lot of my other top stocks right now. Let's actually, I mean, like, where's my Savvy Trader portfolio here? I can't find it. There it is. So, and I got to make sure I actually remember to share my screen here this time. So my Savvy Trader portfolio, you can see a lot of my favorite companies like Palantir and Tesla. I think that Tesla is actually a really great opportunity to buy right now. And you can see that I haven't even had that much of a return on this company. But like, I'm looking at Datadog. I'm looking at Cloudflare that I don't have enough of. I'm looking at the Trade Desk, and I'm looking at Mercado Libre. Like, those companies right there are companies that I am grossly underexposed to. I want to make those like at least, top 5, top 6 companies, because they just execute every single quarter after quarter. But I'm waiting, for to actually be able to buy these companies when the markets do pull back on a broader basis. All right, so that's basically what I'm trying to say. I love Tesla at these prices. So here's the thing about Tesla. I'll make sure I touch upon this. Like I said, I'm 30 to 45 minutes, so hang in here. Tesla is in a macro cycle right now that doesn't favor it, right? Which basically means that there's really high interest rates in the entire vehicle market. It's not just a Tesla thing. It's like the whole dang market. Excuse me. It's the whole dang market right now in the automotive market that is experiencing cyclical disruption because of these interest rates. It's a lot easier to buy cars when it's like 2, 3, 4% interest rates compared to 6, 7, 8, 9% interest rates. So Tesla right now is going through the phase in the cycle where interest rates are peaking, right? So when interest rates are peaking, automotive sales are going to be down. When interest rates go down, automotive sales are going to go up. That's going to be exactly the point that, thank you, John. That's going to be the point that we actually end up seeing that cyclical uptrend again in Tesla. Not only that, so like not only is the macro cycle going to improve for Tesla, because it's really in the dumps right now, which means that it's a beautiful buying opportunity. If you guys actually ended up seeing my portfolio there, Tesla is only like a 5% return, and it's like a 7%, 6-7% position for me. But the reason why I haven't let it grow too much is because obviously I didn't start buying until late 2020 or like mid 2022, maybe early to mid 2020. Yeah. Yeah. I think no, actually it was 2023. Yep. First time I ever bought Tesla was early 2023. Because, obviously I saw it go up. So like Nvidia, I've been watching Nvidia for years, and I just kind of ran away from me. I want to buy the company, and eventually I will buy the company, but I'm going to wait for it to do the Tesla thing. But Tesla is eventually going to have the macro headwinds become macro tailwinds. And that's going to happen in the next year. And for right now, like this isn't going to last much longer. So eventually, Tesla is actually going to end up getting those macro tailwinds that are going to send the stock price higher. Not only that, but it's actually going to be the FSD is going to be rolled out. And they have 2 new products coming out right now. I think it's the Roadster or something like that, Roadster, Tesla Roadster, and then also the Tesla Cybertruck. Cybertruck is ramping right now. So they have new products coming out in the market that's going to lead that next phase of growth for their vehicles and actually expand and help, increase their revenue. And they should all be gross margin profitable or positive. And then not only that, but the FSD, when this actually ends up rolling out, like FSD 12 is the real deal. Like when this actually ends up starting to create recurring, yes, yes, I agree, John. It will be on robots. But right now, in the short term, the FSD for the vehicles is going to expand the gross margin of the overall business because this is software revenue. Like Tesla cars are going to start having software revenue, and there's going to be millions of Tesla cars that are going to have software like gross margins, right? So that's the important thing to know is that like there's three things that are going to be working for Tesla in the next, let's say, 12 months, 12 to 18 months. And that's going to be the FSD software or the FSD revenue, which has a high gross margin profile, the macro tailwinds that are going to exist by lowering interest rates. Because even during a recession, this is probably going to actually be bullish for Tesla because because interest rates are going to come down, right? And then also the products that they're releasing right now. So this is like in the short and medium term. I think that right now, yeah, the Roadster, and right now, this is the opportune time to buy Tesla because none of this is happening right now, and none of this is like projected in Wall Street um, estimates. Right now, they Wall Street's just like, how bad is Tesla going to produce this next quarter's earnings, right? So I think that right now is actually, I mean, I wouldn't mind letting this become like a 15% position for me, just because of long term, we got Optimus to think about, which is going to be, I mean, I can talk all day about Tesla because I'm super bullish. I'm like Palantir and Tesla. I'm one of those classic retail investors where it's like, man, they're doing something special. And sometimes you just got to see when a company's doing something special. Like try not to get too caught up in all like the communities and the hype and stuff like that. But right now, from my perspective, I think the Tesla is one of the best buys on the market. All right, guys, I will see you next week. I'm not 100% familiar on the Trump tariffs in China. All right. So for next week, sorry, John. But next week I'll do probably another YouTube live stream, YouTube/X live stream about this time, 1 or 2 p.m. on Sunday. I want to make sure that I continuously do this for you guys. If you're not already, feel free to follow my Savvy Trader. You guys can actually see that right here. This is going to be the link on my X. On my X profile. So feel free to jump on that if you guys want to. I'm going to share a lot of updates throughout the week. Yep. Have a good week ahead, everyone. Appreciate you guys. And until next time, you stay classy.